Hello everyone, this is Kamali from 2nd MCom. My seminar topic is approach, which means a Mordinary and a Miller approach. It was proposed by Francisco Mordinary and Metron Miller in 1958. This theory is considered as the foundational theory in finance that addresses the capital structure's impact on the firm's values. Approach explain the interrelationship between cost of capital and capital structure and the value of the firm under two conditions. The first condition is when there is a tax exist, and the second condition is when there is no corporate tax. If the tax was ignored, this theory was identical to the theory of a non-operating income approach, and it was also called as theory of irrelevance. If the taxes exist, then this theory is called as the theory of relevance, and it is similar to the net income approach. Next, we are going to see about the assumptions. First assumption is there is no corporate tax, which was related to the theory of irrelevance. It explained that there is a no tax, and the firm does not need to worry about the changes in the capital structure, because according to this theory, if there is no tax, the capital structure of the firm does not affect, and there is no need to claim any tax shields. The second assumption is perfect capital market, which means there is no transaction cost or tax, and the information are equally access to the all investors, and there is no monopolistic power. And the third assumption is investors act rationally, which means investors are aimed to gain maximum of their wealth, and they evaluate all the investment opportunities based on their risk and return. The next assumption is the expected earnings of all the firm have identical risk, which means all the firm are having a similar risk, whether it is a leveraged firm or unlevered firm. Next assumption is all the earnings are distributed to the shareholders. This assumption is try to explain that the company earnings are equally distributed to the shareholders. The next assumption is constant operating income, which means the firm's earning before interest and tax, that is EBIT, or constant and not affected by the capital structure. There is no growth or decline in the firm's operating income. The business risk or remain constant. Next, we are going to see about the theory of relevance, which means a corporate tax exits. Again, we are dividing into two categories to value the theory of relevance. The first category is value of unlevered firm, and second one is value of levered firm. The term unlevered means the company has no debt, and the levered means company have debt. uh, and the approach explained that the levered firm, which means one that uses the debt, have more value than the unlevered firm, which means the company which does not use the debt, because of the tax shield provided by the debt. And I also given the formula for both levered and unlevered firm. The formula for levered firm is EBIT divided by KO. KO denotes overall cost of capital, and the levered firm is equal to unlevered plus tax into debt, because unlevered firm uses the debt, so we are adding the tax and the debt. This is the pictorial reference of the model under the corporate tax exits. That means the theory of relevance. As we have seen before, the levered firm has higher than the unlevered firm due to the tax shield. This diagram explains that concept. The degree of the degree of leverage of the unlevered firm was lower than the levered firm. Next, we are going to see about the theory of irrelevance, which means when there is no corporate tax exists. This theory proves that the cost of capital value of the firm are not affected by changes in the capital structure or debt equity mix, which means if the firm has higher debt, lower equity, it does not have any changes or any impact on the cost of capital and vice versa. The value of the firm is independent of its capital structure. In other words, the firm finance does not affect its overall capital. The value of the firm is dependent on the expected future earnings, because here is no tax shield is available, there is no tax exists. Due to that, if the company want to increase their debt or increase their equity is based on the future requirement. This is the pictorial representation of the second concept. If the tax is not exists, and this theory is called as a irrelevance. Here the cost of overall cost of capital is neutral, and it does not affected by the cost of debt or cost of equity, which was explained in this theory. Next, the limitation. Even though it is a foundational theory of the finance, it also have lot of limitations. It does not applicable to the real world because of some limitations. First one is no perfect market. In real world scenario, there is no such term called perfect market, which means the market condition is uncertain and we cannot predict the market, and there are lot of monopolistic competitors in the market. Second one is transaction cost. Transaction cost exists in all type of markets and all type of business. Third one is risk characteristics. In the assumption we seen that there is a identical risk, uh, but in real world scenario, business have acquired different type of risk, even if it has a same genre of work or same genre of operation, it was acquired by different type of risk. The next limitation is cost of borrowing. The approach stated that the individual and the levered firm can borrow their fund for investment at a same rate of interest, but in real world scenario, there is the such things or does not exist. The rate of interest was differ from the individual and to the firms. Next limitation is restrictions on the institutional investor. The institutional investors are restricted to the personal leverages. Next limitation is corporate tax. Corporate tax plays a major limitation in the approach because it has a major impact in the cost of capital and the value of the firm. While the approach states that the corporate tax does not have any impact on the value of the firm. Thank you.